In the world of taxes, things aren't always as they appear. The IRS wants to make sure you're playing by the rules. One important rule is the business purpose test. This test helps the IRS decide if your business transactions are legitimate or if they're just for avoiding taxes. The business purpose test matters for everyone, especially corporations. It can affect your tax deductions, credits, and even your company's structure. So, understanding this test can save you from a lot of trouble. This isn't about tricking the system. This is about smart business. Always remember, a solid business purpose protects you and your hard-earned money. The business purpose test has two main parts. First, you need a real business reason for your transaction. It can't be just about saving on taxes. For example, merging with another company to expand into new markets, that's a valid business purpose. But merging just to get a lower tax rate, that might raise red flags. Second, the way you structure the transaction must also have a business purpose. Let's say you're selling part of your business. You could structure it as a sale of assets or a sale of stock. Each has different tax implications. Choosing a structure just because it saves taxes without a valid business reason could be problematic. Remember, the IRS is looking for substance over form. They want to see that your transactions make sense from a business perspective, not just from a tax perspective. The business purpose test didn't appear overnight. It came from court cases where taxpayers tried to get away with tax schemes. Over time, courts developed this test to prevent abuse. They said, look, you can't just do things solely for tax reasons. Today, the business purpose test is everywhere in tax law. It applies to all sorts of transactions, from forming a corporation to claiming deductions. It even affects how companies structure their operations. The lesson here, be aware, understand the potential tax consequences of your actions. What seems like a clever tax strategy now could backfire later. The IRS takes the business purpose test seriously. They have skilled auditors who examine transactions closely. If they think your transaction lacks a business purpose, they can deny your tax benefits. This could mean back taxes, penalties, and even legal trouble. The IRS isn't out to get you. They just want everyone to pay their fair share. By making sure your transactions have a solid business purpose, you can avoid problems with the IRS. Remember, honesty is the best policy. When in doubt, talk to a tax professional. They can help you structure your transactions in a way that makes sense for both your business and the IRS.